Ladies and gentlemen, it is my pleasure to welcome you all back to our quarterly investment and market update as we review the last quarter and we talk about what's going to happen in the new financial year. We are here thanks to Virtual Financial Advice, making financial advice affordable for all Australians. My name is Paul Jans. I will be your host, and it's great to have you all back for another quarterly investment and market update. Now, firstly, let me welcome our CEO, Virtual Financial Advisors CEO, Adam Besrovic. How are you? Welcome back. How are you,
Good,
mate?
mate. Excellent, mate. Excellent. Just before I start,
Excellent.
just want to make sure we say that everything today is just general advice. We haven't taken into account the objectives, financial situation or needs of our clients. So obviously, make an appointment if you want to discuss it in further detail.
Yeah, well
But
said. Well said. You beat me to it a little bit there, but that's all right.
that's okay. And yeah, look, great to have these quarterly updates for our clients and to have Rob on board. Yeah, for sure.
Fantastic. You beat me to that as well. Rob Coit, CEO of Chartreuse Wealth. How are you? Welcome, mate.
Yeah, good. Thanks, Paul. Thanks for having me.
It is great to have you back. Now, guys, let's get into this as we talk about investment and market update. Rob, let's start with you. Let's talk about the last quarter. How do we close the financial year 24?
Yeah, so the last quarter from an Australian share perspective was a bit negative actually. So we had Australian shares closing down probably about just a bit over 1%. But the small companies index was down closer to 4.5%. And then our listed property component fell around about the 5% again. But in saying that, it's had a very strong year. So, I think we've got it here in front of me. It's still up over 20% for the year. So,
Okay.
unfortunately, markets don't move in a straight line.
Yes.
So that's all par for course. International shares was a little bit up for the quarter, and the bond market was a little bit down. So it was an interesting quarter, but there was probably a little bit more excitement after the quarter.
Absolutely, no doubt about that. So let's talk about that a little bit. I suppose we've had a couple of international elections as well. So elections in the UK, elections in France. Do you see change or that sort of change impacting our markets at all?
No, I don't. Well, I don't think the market's putting much heed to it. And from a personal perspective, especially on the Western government side, I don't think it matters who they elect. We're not going to see the reining in of the massive spending, the large levels of government debt, which are basically, I think, they're the major, or they're the foundation, I think, for what we see going forward for quite a number of years. And regardless of who gets in, I don't think that's going to change.
Okay, and you don't think that will affect anything with the US as well now that Kamala Harris is going up against Donald J?
From the government spending perspective, no. Where it probably would be a bit different in regards to the US is the geopolitical.
Okay.
So I could see very easily Donald Trump coming in and trying to do a deal with Putin to put the Ukraine to bed. And indeed, I think that's something that should be put to bed. They've lost a lot of lives over there, and I can't really see what it's all about. And then obviously we've still got the Middle East.
Yes.
So that's whether there is, whether Donald Trump's going to treat the Middle East differently to a Harris administration. I think it's probably fair to say he would. So I think there will be geopolitical considerations. But from a debt perspective, a spending perspective, I don't think it matters.
It's going to matter. Yeah, fair call, fair call. So staying on the US for a second, I suppose last week, the Wall Street suffered its worst day in 2 years. And as a result, the ASX also had its worst day since 2020 with close to $100 billion wiped off the ASX. What's your thoughts on that to start the financial year?
Yeah, well, I guess probably, and those that have sat in on these calls for a while now, we've been saying that one of our major concerns is valuations. So valuations in equities are very expensive by historical standards. So when I say that, based on how much money these companies are making and what they're trading at, they're expensive. So when things become expensive, that's when investors sort of think, well, has this run its course, or indeed are there other better opportunities elsewhere? So it's not uncommon to get this sort of selling action in these periods of time. What we saw was a very fast sell-off, and indeed we've sort of seen some stabilization, and that's normal. So basically what's happening is you've got this tug of war between people that think it is too expensive, this has run too far, and those that think it hasn't. And that'll take time to play out, and over the fullness of time, it will. But as I said at the start, it doesn't go in a straight line,
Yes.
which makes it more exciting, but that's also the opportunity for more patient long-term investors as well.
Yeah, it's a good point. So the key is patience, as you've just said, and don't react to things like the news where 100 billion wiped off the markets.
No, definitely not. And from our perspective, we take a risk-adjusted approach. So we're not exposed heavily to that stuff anyway.
It's a good
right?
point.
So if the markets as a whole is selling off because of a subsector, well, it doesn't make sense for you to sell off if you don't really own it.
Yep.
And indeed, you want to benefit from what they call the rotation. So I noticed there's been a bit of talk about this rotation. And all that is people going, AI is at its time in the sun. Now we need to get back to more boring, fundamentally cheaper businesses that are making good money, and they look like a better investment alternative.
It's a good point. Anything you want to add to that, Adam?
Yeah, no, look, it's very interesting. I mean, obviously, with Rob was saying, the MDA and risk-adjusted portfolio is what we definitely use for our clients. But we also, for some of our clients, we have direct share portfolios. And I think it's really just a matter of, in these times, is investing in quality companies, no debt, billions of dollars in the bank, return capital to shareholders, having the right mix. And, obviously, where it can become unstuck is if you're investing in companies with high debt and low cash flow, it can become, so obviously with us, we definitely, when we're doing our direct shares for our clients, we're definitely focusing more on no debt and more quality stocks, like Amazon and Microsoft, all the top companies.
Yep. Well, I was going to ask you about that actually, because, with uncertainty of interest rates and the economy, investors may be wondering what are the sort of stocks to buy against this uncertainty. What's your thoughts on that? You just mentioned Amazon. And
obviously, I'm not the investment manager at Chartreux or at one of the other companies we use as private portfolio managers, but obviously both the investment managers that we use have the idea of making sure we invest in stocks that are quality, low debt or no debt, money in the bank, return capital to shareholders, just fundamentals.
Yep.
I think it's very important when things are, all this kind of, I suppose, noise we've had lately.
Yeah, fair call. And Rob, what's your thoughts on that?
Yeah, I think from an investment perspective, I think Warren Buffett talks a lot about this. The best way to protect yourself is through buying businesses or assets that are reasonably valued. Make sure you're not paying too much for things.
Yep.
And then also make sure that you're also buying a business that then has the ability to grow its earnings. So if you've got those two boxes ticked over the long term, you'll be fine. There'll be short-term impacts, but basically if you've bought well and that business continues to do well as an investment, you'll be fine.
Yep. Fair call. Fair call. Now, I'll come back to something you mentioned before, which was AI, and also Adam mentioned, noise. So I suppose there's a lot of noise around call it the cybersecurity companies, artificial intelligence, cloud-based tech software companies. Is this still, you sort of mentioned that it's coming off a little bit. Is this still what we should be looking at in the future? Or is it those boring vanilla type of companies with low debt and good growth, as Adam just mentioned?
Yeah, well, it gets back to there's a difference between a good investment and is this going to impact upon our lives, right? I think it's obvious that it will impact upon our lives. And I think I've mentioned previously, this reminds me a lot of the tech wreck the tech boom, the tech wreck. Same thing. Everyone knew the internet was going to change the world, but that doesn't necessarily translate into a good investment. If we're paying too much for businesses that aren't going to grow sufficiently to substantiate that valuation, well, it's not going to be a good investment. So we need to make a distinction between the two. And from an investment perspective, my view is that a lot of these valuations are really stretched, and what's actually factored in to these valuations, we would actually argue it's not even possible. So, for example, they've got to sell that much stuff that it's greater than global demand. So, from that perspective, we're very wary of what's going on there. But it will play out over time. But to me, it smells a lot like the tech boom and the tech wreck that we saw at the turn of the century.
Okay, good call, good call. So let's have a look at, sort of bringing you back to some of the fundamentals that you just spoke about, that looking at ASX companies, what should we be looking for in terms of long-term success, attractive valuations that you just spoke about? What's important to understand? Can you share some of the, company fundamentals, if I can get that out right, company fundamentals when looking at shares like these? What are those fundamentals?
Yeah, absolutely. Well, it's interesting that I had a catch up with a gentleman by the name of Paul Moore from PM Capital, and he did a presentation on exactly this to our network. And he compared Commonwealth Bank of Australia, which is one of the biggest companies in Australia, to one of its peers over in the UK. Now, they're very similar size, similar profitability, similar everything, basically. From a technical perspective, the way the UK bank was funded was probably less risky, so that should have made it more valuable. But for all intensive purposes, let's just assume they were very, very similar. Commonwealth Bank was effectively valued at 22 times its earnings, and Lloyds Bank was valued at 7 times its earnings. So what that means is that you're buying effectively the same thing, but you're paying 3 times the amount of money for Commonwealth Bank than you are for Lloyds Bank. So from an investment perspective, why? The other thing that he mentioned was traditionally when you're seeing a 22 times earnings on a multiple, you need that company to be growing its earnings to justify that valuation. The Commonwealth Bank over the last 10 years, as earnings have been going up about 1 or 2%, i.e. it's not enough. But he also compared that and contrasted that to Google. You can buy Google at around about 20 odd times earnings, and its earnings have grown over the decade at about 20% per annum.
Right.
So when you put your investment hat on, should we be buying Commonwealth Bank? Right? And then he also spoke about passive investment flows and these sorts of things and how that might be contributing to this. And I think I've mentioned previously, at the moment we're very wary of passive investing, and we're actually skewing away from a number of things like Commonwealth Bank, like the tech sector in the US. So we're actively taking positions against that, which over short periods of time that might hurt you. But over the long period, we believe that those positions will be rewarded relative to taking large positions in those what we consider overvalued companies.
Okay. Good points. Adam, anything you want to add, mate? That's interesting.
Well, I think just the Commonwealth Bank, obviously Australians, it's been Australian favourite for 100 years. So, I think it gets a lot of money that way. People just invest it. I've got one client actually against, our advice, but has all of their money in the Commonwealth Bank. And we're talking a couple of million. They don't have any other stock except Commonwealth Bank, and that's just kind of the draw that bank has. But obviously, as Rob just pointed out, at the P ratio of 22, is it good buying? Yeah.
Mm.
Mm.
Interesting. Well, guys, as we look to wrap up, let me pose this one to you because I'm sure there's a lot of families watching this. I've got 3 young boys, 14, 12, and 9. I want to educate them with regards to investing. We've started to talk about it. Unfortunately, they get drawn into, and I know we spoke about this last month, Rob, but they get drawn into the Teslas of this world because Elon obviously yells, and that's what they want to listen to on the likes of what's it called now? Not Twitter, whatever it's called.
X.
X, that's it. So are there key sectors we should be looking at, and are there platforms we should be researching for our young little investors to start looking and getting them educated?
Absolutely. And young or old, it doesn't matter. I spend a fair chunk of my week reading. It's a very important component. And unfortunately, with investing, and I can speak from experience, we learn some of our biggest lessons by the actual doing. So, to me, it always, and I encourage clients to, if they're interested, go and buy some shares and do this and do that. But it gets back to don't have all your money in it, right? Just do a little bit, learn, et cetera, because it's quite difficult. And it's really a discipline. But before you get to that point, it's about education. So read all the books you can, find some good sources of knowledge, and there's a lot of good sources out there. There's a lot that aren't so good. I'm happy to provide, I've got a list of books that when clients ask me, I want to know more about investing, what should I read? It's only about 4 or 5, and then most of them are actually quite old, which is interesting. But to me, they're the go-to. Because you've got to have the knowledge firstly, and then you've got to have that discipline that comes into investing, which is, it's pretty unique, to be honest.
Yeah, but
because it's anti our normal instincts.
Yeah.
When something's exciting and running, you've got to be wary.
Yes.
And vice versa. When the world's collapsing, you've got to be looking. So it's it's different, and I don't think it's any coincidence that the best investors of the world that the world's ever seen, guys like Warren Buffett, etc., they are few and far between.
Very true. Adam, what's your thoughts on that?
What I tell clients when I see them and they're talking about maybe setting up an investment account for their kids and not sure how to go about it, and obviously they say, well, I don't want to use a financial advisor because it's going to cost too much money. I kind of steer them normally down the path of maybe investing with Vanguard. Has a great website. I just advise them to look at the young kids, just put them into a growth portfolio. A number of my clients have done it and come back to me and said how well it's been and how great the experience has been for them. It's very simple. Just the website's there, and they just jump on, set up an account for their kids, money in it, and they can make a regular contribution every month. And it takes away that habit of pick stocks and all that sort of stuff. Vanguard have the index. You just invest in the index. But, long term, obviously for their kids, they're investing 10, 20 years. So it's a long term investment.
Yeah.
That's kind of where I go along for, that's the advice I kind of give my clients if they want to invest for their kids. Yeah.
Brilliant. All right. Well, thank you. It's something that I know we've spoken about in here for a fairly long time and we haven't done anything, but maybe it's time to look at that. So it's great. Well, guys, as we look to wrap up, any final comments from both of you? Anything from you, Rob?
No, the key is just make sure that your portfolio's positioned with the right strategic asset allocation. You're aware of how much risk you're taking, making sure that that's appropriate for you. I dare say it might get a bit rougher as we get towards this election.
Okay.
But in saying that, if you put your portfolio together in a way that it's, you've really just got to sit tight and ride it out.
Yeah. Great advice. And Adam, any final comments?
Just like to thank Rob for coming on today. Much appreciated. And yourself, Paul, thank you for everything. And for our clients, feel free to reach out, make an appointment, and we can discuss, investing in the risk-adjusted portfolios, the MDA or our private portfolio managers' portfolios, and give them some advice. Yeah, thanks, mate.
Beautiful. Well, thank you. Thank you to both of you for joining us today again for a quick little update. On behalf of Virtual Financial Advice, to all of you guys that have joined us and have been watching these, thank you again. And we're signing off until we see you next time. Thanks, guys.